Hi, everyone. Welcome back to the Brydge Club podcast. Super excited. Today we have Cheryl Kellond on the show. She is the founder and CEO of PlayMoney, an investment platform enabling everyday angels to build a diversified startup portfolio without making angel investing a full-time job. Cheryl is a 3-time founder, having previously built Bia Sport, the #1 rated fitness wearable on Amazon, and Apostrophe, which she built to $10 million in ARR and was acquired by Centivo. Cheryl is also an avid angel investor herself, so really excited to have her here today to learn a bit more about her founder journey and also learn a lot more about angel investing. So welcome to the show.
Oh, thanks so much for having me. I'm stoked to be here.
Amazing. Well, to kick it off, why don't we just go back to the beginning? Tell us more about why you went out and started your first company. Bia, we were just talking about how you were in corporate America before, had a big corporate job. So how did you ultimately decide to take a bet on yourself, and what did that first company building experience look like?
Oh my gosh, the way you asked it, it made it sound like it was such a glorious moment. I mean, pretty much I was drinking too much wine one night with girlfriends, and we were all triathletes. And we were like, man, these Garmin watches suck. They're too big. They're too confusing. And like, if you've got the right friends, if you drink enough one night, you think you can do anything. And so after a couple bottles of wine and some texts to some other girlfriends, I was convinced we could build a better product than Garmin built. And I was pretty sure I knew who could do it with me. So like, it was a moment of complete stupidity. I was ready for a break though, right? Like, I had spent my career switching between big corporate and other people's startups. And I knew one day I was going to want to do my own, right? I was like one of those employees that lasted about a year and a half, 2 years. I'd get my big project out the door and then I was like, bye, on to the next thing. So it felt like the right time because, again, enough wine and we totally can invent consumer electronics from scratch. That seems like a totally plausible thing to do. So we did. But yeah, it was a moment of misinformed stuff, but it worked, right? Like,
It's all about the community you have around you. So I love that about your friends that encouraged you to take the leap. Okay, so tell us how you actually got Bia off the ground and how you got that business really going.
oh my gosh, that was getting Bee off the ground was so crazy. It was back in the day where everyone thought you could launch a consumer electronics company by doing a Kickstarter and then using the money from Kickstarter to build the company. So we did a Kickstarter and it was back in the day and we were one of the biggest Kickstarters at the time. And it was a sports watch, particularly for women. It was sized smaller. It was cool colors. It had an integrated safety alert, which doesn't sound like a big deal now, but it was long enough ago that we didn't all bring our cell phones with us. So it was sort of a big deal. And so we had this ginormous Kickstarter, and it was the most amazing thing in the world because what it meant is I was building a community run hardware company, right? I had 4,000 passionate users who had been with us from day one. And that was such an asset building that company along the way. And I would say even more than the product itself, it was one of the reasons we became the #1 rated product on Amazon. Obviously, the Kickstarter money wasn't enough to build consumer electronics from scratch. So we also raised from angels. And we were one of the very first companies to raise on AngelList back in the day. Back in the day when AngelList was fun, and every Sunday Naval used to push out an email like pimping his favorite 1 or 2 companies on the platform.
Whoa. Yeah, tell us a bit more about like how did you approach angels and kind of get angel dollars for that first company?
Oh goodness, that's, it's such an interesting question because that was long enough ago that there was one place, it was AngelList, and AngelList back then was really different. It operated more like a deal flow discovery platform to find the best new startups. Naval's point of view and promoting your company really mattered. You met angels face to face, but that's sort of the easiest place to find them back then because it was before these times when everyone was maybe an angel investor. So in some ways, it's weird, right? Because it was a little bit easier to find them back then because there weren't as many of them, which sounds like it doesn't really make sense.
Totally.
but it also sucked because there weren't as many of them. And I think one of the best things that's happened over the last 5 years is that there's so many more people writing early stage checks.
I don't want to go there yet, but later I want to hear a bit more about how angels have changed over the years and also your advice for founders today of how you tap into angel networks. But before we go there, tell us about your second company. How did you go from Bia to Apostrophe, and what did Apostrophe do?
So Apostrophe was really different. We were a healthcare fintech. It came out of the same motivation of like, there's something better we can do here. I had read a case study about a hotel chain in Florida who did something really creative with their health plan that just like delivered all these amazing benefits. And again, if you team up with the right people, everything seems really feasible. And so we were going to take what they did and put it on a SaaS platform. It was a really interesting company, right? We grew super fast. Like we got acquired 4 years after we started. We got to almost 10 million in ARR super quickly. There were things about it that were awesome. We were selling this new innovative health plan to mid-sized employers in the industrial Midwest. And it definitely made a difference in these companies' profitability and these people's lives. But two things happened. First of all, we ran head on into the pandemic. It is not a great time to convince an employer to switch their health plan when their HR team is dealing with freaking out over a pandemic. The second piece was I loved the problem we were solving, and that's what everyone tells founders to do, and make sure that you have. But what they don't say, and what I've learned along the way, is you also have to be in love with your customer. I loved my customer at my first company, right? There were women weekend warriors and mother runners. My second company, while I loved our members and the people that used our product, I was selling to like mid-level HR managers and their brother-in-law benefits brokers. That was not my cup of tea. So I learned that lesson the hard way. And so when we were acquired, I was very happy to let it go and have no strings attached. I wanted to go back and work with not just a problem I thought was important, but a customer I loved.
Yeah. I feel like that's just probably what keeps you going on a daily basis, is like interacting with the customers that you love. And I'm sure that's like the most fun part of it. Can you share anything about the acquisition process? Like any big learning lessons from that experience?
We're going to have video on this interview so people can just see me roll my eyes. Most founders that have an exit, there's parts of it that are very unpretty. So no, there's not a lot I want to share. I blocked a lot of it out. Yeah, strange series of events. Capital protects capital at the end of the day. I would say VCs are going to stick together whether they think each other is doing right or wrong. They're going to stick together because they need to do the next deal together. And that's a little bit of what my process felt like at times.
Any like takeaways or like things that you're doing differently when you're building PlayMoney, considering that experience? Or
so that business there was just naturally a lot of upfront costs in it. So I had to grow to a pretty big scale till I could even imagine being like unit cost positive, let alone, cash flow positive. So it had a high hurdle rate there. So it was a business that required us to raise a lot of money up front. And what I learned about myself is I would rather have more optionality than that. I can raise VC, like I've raised probably close to 20 million over my career, but I didn't want to have to raise it. And so that was definitely a part of the thought process going into PlayMoney is how can we make sure we had a revenue model or a scaling model that gave us optionality on how we wanted to take in capital and what we used it for, to give us that optionality early on.
Totally. I think it's so important, especially like I feel like in this day and age where like raising venture dollars is like for some reason this like super exciting thing. And like sometimes there's reasons where you might want to just stay away from it. And if you can build a business without it, like that just means you have more ownership and control of what you're doing.
Yeah, no, I think it's weird how we have started to equate raising venture dollars with some kind of our sense of self-worth as a founder or the value of our business. And that just doesn't make sense, right? Like VC is a pretty particular financial instrument with certain rules around it. And I mean, it just sounds so silly to say, so, like if your business doesn't fit that, that doesn't mean it's not worthy. But what we've seen over and over is there's businesses that are growing to $100 million and $250 million and really big, important businesses. But that doesn't mean that an exit would satisfy a VC. And so I think we've really convoluted creating some kind of personal worth as a founder with, do we fit the rules of this asset class? Which I don't love.
Completely agree. I feel like it's hopefully shifting. I feel like I used to work a few years ago at like a Andreessen Horowitz backed company, raised like $120 million and they've now gone bankrupt. But I feel like during that era, I really felt like maybe it was just I viewed that as success, but now I'm like hyper aware of like that really means nothing. If anything, it might make me a bit more skeptical of what's going on inside of a company. How did you eventually decide to start PlayMoney? And why did you decide to do a third company and build this new angel platform?
Oh my gosh, right? I'm a total idiot, right? But by your third startup, like you cannot get hired to do anything else. Your choice is to be a founder or I don't know what. And I'm sort of I'm a product builder, so like I wasn't really the founder that was like going to start a community or a newsletter. Like I'm a product founder. So after I sold my company, I did two things. I became an EIR at Techstars, and over about 2 years, I worked with pretty close to 200 early stage founders, all of them female. So I was spending full time with founders, and then I got into angel investing, not necessarily intending to write checks when I started, but to teach myself to be a better founder myself and a better mentor to the startups I was working with. But once I got in that space, first of all, I loved writing checks, right? Like it's so powerful to be an angel. But it took me a while to start writing them because I wanted to sort of understand the asset class, right? I was hearing people say, you're going to lose all your money or whatever. So I dug into it and I learned about how much portfolio diversification you needed to do an angel to make it a sort of smart and a more high performing investment. And then I went out and tried to make that many investments myself, and it was too hard. So PlayMoney came out of the fact that on one side, I'm working with all these founders who are trying to raise capital. And it was like a Where's Waldo? Who do I talk to? What angel group? What angel? Like there were so many check writers and yet no check writers. And then over here, I was a check writer trying to write 15 checks a year. And I was having to look at like 20 and 30 deals for each check I wrote. And I was like, this isn't even fun anymore. It's horrible. PlayMoney sits at the intersection of that. I want to solve that problem for founders and for funders because that's what's going to get new kind of capital in the mix. And that's what's going to help founders move faster.
First follow-up is like, who should be angel investing? And to your earlier point, like when you did your first Kickstarter campaign or your second company on AngelList, now I'm forgetting, but there was only kind of like this one group of angel investors. Like what has changed kind of since then? And yeah, who should actually be investing in this asset class?
Oh my gosh, the changes have been amazing. It feels right now some days that everyone's writing checks, depending on where you are. But I would say this, and this might be a little bit controversial, but I think anyone that can sort of look at where their career is and look at what they've been able to save for retirement and sort of project forward on their income stream and say, you know what, I think I'm going to have enough to retire on one day. I think if you can look and say that, then you are totally, and you're an accredited investor, I think you should totally be angel investing. That doesn't mean with all your assets, still maybe with only 5 to 10% of your assets. But angel is the most powerful form of capital, right? If you write that first check, you decide what problems get solved and who gets to solve them. And more of us need a say in that. So I think more people should be angel investing. And you can be an angel investor that digs in deep or one that just stays on the surface. But if you're building a diverse portfolio and looking at credible startup opportunities, there's no reason not to have it in your portfolio. Which is a crazy hot take, maybe.
I don't think it's a crazy hot take at all. I'm totally on the same page with you. And I think a lot of people are super curious about diving into this. It's just more been in the past, it's been so difficult to access and so difficult to actually
Right.
do, to your point. Like
Mm-hmm.
in your first year of investing, can you share a little bit more about like maybe how much you allocated to each company and like what does the process look like of finding deals before PlayMoney so people understand like kind of how challenging it is and how it is a full-time job. Yes.
Yep. No, it absolutely is. Oh gosh. Okay. So for me, I'm a loud and proud baby check writer. I write checks between 1,500 and 2,500 bucks, and I write about 15 of them a year. And sometimes I'll do a bigger check. The math says I shouldn't do a bigger check, but when I write that bigger check, I take the money from a different budget. I don't take it from my investing budget. I take it from my shopping budget, my philanthropy budget, my doing social impact budget. I take it from a different place. And I've been pretty consistent with that over the last few years. I'm also pretty upfront that I invest out of my retirement funds because all my current funds are either going to compensate for the fact that I'm not getting a paycheck or going to pay college tuition for my last two kids. So that's just how I do it. I am super lucky when it comes to deal flow because I spend my whole day living and breathing startups. Like it literally is my job. My side hustle at Techstars funds my angel investing. I live and breathe in the space all day. If you're not living in Silicon Valley in New York and working in tech though, I have no idea how you find startups. Like seriously, I just don't know how you do it. And maybe that's why a lot of people end up, throwing $25,000 into their next door neighbor's hot sauce company, right? Like you hear about dentists that do that all the time. I don't know how people off the coast and not in tech find high quality deals, and particularly enough deals to build a diverse portfolio in, which is exactly why we started PlayMoney. I'm seeing a lot of people join angel groups, which I think is awesome because money is more fun with friends. And if it's a high velocity angel group and they're seeing a lot of deals and are well connected, that is a great place to be. I've also seen angel groups that like get a little bit of, maybe C-tier deal flow, things that sort of aren't quite there. I think it's tough. I haven't seen anything that makes that a lot easier. Right? Where you can see really high quality vetted deals matched to you on a regular basis.
Can you share a little bit more about like what you mean by high quality deals and how do you feel like that it's a high quality deal you're looking at versus something that might have less probability of succeeding? Because I think there's definitely like confusion out there around that.
There's not one great measure of what a high quality deal is going to be, which is why you see, thousands of early stage VCs all investing in different companies. There's not one pattern of that. I think what I mean by like a high quality deal is like, you get the sense that the founder knows their domain and what they're doing, and they're really aggressive. And for early stage investing, that they're operating in a space where their company can become big enough, right? Like no matter what your new company is doing, there's a higher probability that it fails than it succeeds, because that's just the reality of taking a risk and starting something new. So you want to know a company can get big enough. So maybe a company that could never be big enough, bigger than, $5 million of revenue a year, sort of not going to cut it. But I think it's a pretty subjective thing, and I probably shouldn't have used that term.
I feel like some of like the startup investment platforms, I don't want to name specific names, but I feel like a lot of people got burned by some of the crowdfunding equity platforms back in the day. And so I think it's like a clear distinction of like, you really care. PlayMoney is like working with actual like VCs to bring on quality deal flow. So I think it is an important distinction of like what you are building is the only reason I push on it.
No, it's a great question. What constitutes quality deal flow? And it's interesting because so the platforms that have existed in the past, I think you've got two flavors of things, right? You've got equity crowdfunding, which is any founder can put any deal up on that site. So it's not necessarily a clean, well-lit place, right? It's a giant strip mall There's no curation. There's no vetting. There's just sort of anyone can be there. Then you have like AngelList syndicates. And there's ones that are really good, and those are usually very private. And those ones also are usually early stage companies. Then you get these other ones that sort of everyone can get in on, and it's later stage companies. And like, I'll say this, and again, hot take, but super early stage companies are awesome. Because as an individual angel, you can get in the best of them or the worst of them. Like, you can't really tell where that company is going to be. So what you have access to could easily be the cream of the crop. When a company gets later stage, unless you have a special kind of access or you have a syndicate lead that you can really, really trust is getting great deals, I think sometimes you have to wonder, why are we seeing this deal? Why is this company that's doing so well at Series B going out and taking some money through a syndicate? Not is it really going as well as you think? Am I the angel getting 100% of the information and insight that a VC is? And at a later stage company, you can't see everything a professional investor sees. You can't look into the cap table. You can't dig into the financials. As an individual angel, you're not going to get that access. At an early stage company, you are absolutely seeing 95% of the stuff that an early stage VC is, because there's not a lot to see. It's a judgment on how big the market can be and a judgment on how awesome you think the founding team is going to be. So when I say something like high quality early stage deals, and you know that we're doing this on PlayMoney, we're taking stuff that has some level of professional investor already in it. And that could be an early stage fund. That could be a super angel. It could be a high velocity angel group. What we're looking for is someone who sees hundreds, if not thousands of deals for every check they write. Someone that has that amount of exposure said, hey, this company is standing out. So I don't know if there's a strict, oh, this is quality, this is not quality. But if someone who sees hundreds and thousands of deals for every bet they make says something is special here, to us, that's a flag that in the early stage, it's a clean, well-lit space.
You mentioned like how big can this company get? Can you talk a little bit about what you mean by like market sizes that you're looking for? And is there a difference between what like a VC might want in terms of how big something could get versus an angel investor?
Yeah, when it comes to how big something can get, I think we can make a different set of decisions on that as angels that maybe VCs can't make. We all need a certain high multiple return because most of our bets are going to fail, and the ones that win have to make up for that. But there's two components to how big it can get. It's like how big the business can be, but also how much capital do they have to take in to get there? And how long is that going to take them to get there? So as an angel, if I can look at a company and say, you know what, I think this company can 25x or 50x, and I think that can happen in, 5 to 7 years. That's a different set of calculus from a VC looking at it and saying the same thing, right? The VC needs to think they can 100 or 1,000x, and like, they're going to wait longer for that to happen because then it can return more absolute capital regardless of multiple. So there's a little bit of difference. Like as angels, we're looking for a cash on cash return. And if we're going to get, 20x our money in 3 to 5 years, that's amazing. That might be a better bet than, whatever. I can't do math like that fast in my head, but 50x our money in 10 years. So there's a difference there. I think angels, though, we still need a multiple on that return. So when I look at a deal, I have to say in my head, can I imagine this company getting big enough to be 25x the money I'm putting into it? And that's not because I just need a 25, X return on this one deal to offset the ones that don't make it. It's a little bit because like, if I can imagine it going to 25x, well, then I know the founder can imagine and find a path to it for it to go to 50 or 100x. Because founders are growth-seeking missiles. We all are. We're sacrificing so much for what we do. So I think if I can see the market being big enough for that, that's when I'm like, okay, this can be comfortable.
To that point, can you talk a little bit about like the exit opportunities that some of these companies have, and like what's like a typical angel return that people should be targeting?
Typical angel return is really hard because if you understand the math behind angel investing, it's not about any one company. It's a shots on goal game. You need enough shots on goal to have one or two outliers in there to deliver an asset class that predictably performs better than public markets, right? Like that's the goal. We have to perform enough better than public markets to make it worthwhile to have our money locked up on that. Like that's our goal from the financial side, right? Angel gives us a whole lot of non-financial benefits. But from that perspective, you want that to happen. And there's actually some great data out that came out from 500 startups a few months ago. And they looked at their 2,500 investments they have done over the last 10 years. 50% of them went to zero. 40% returned 1 to 3x, which means 90% of their portfolio added up so the fund, got their money back and broke even. All of their gains came from that last 10%. And about 8% of those companies, they did about 20x. So they were good, solid returns. 2% were the ones that went through the roof. They were the Ubers. They were the, 100x, 1000x, 10,000x. And so if you think about that, same math applies to us as individual angels. So your return, it's not about the return from any one investment. It's the return that you can expect if you make enough investments to have a diversified portfolio and get lucky enough to get those winners in there. That's a total math geek game.
Can you explain a bit about like how PlayMoney works today? I don't know if you're allowed to share like an example company that has raised on the platform, and what does it look like for both like the founder and the angels coming onto the platform?
The coolest thing though, that I think you have to appreciate, like if startup portfolio building is about diversification and making enough bets, what that also means is that anything you bet on is probably right? Like it's as most likely to be right or wrong as anything else. So as individuals, we're already better angels than we know, right? It like liberates you a little bit, right? Like if I'm making enough bets, if I think this company is good, I should invest in it. There's no right or wrong answer there. It's too early to be knowable. And I think to me, that's what's made angel so much fun. Like I can't necessarily be wrong. There's no way to know I'm wrong. I can't do more research to decide if I'm right or wrong. I can trust where my heart goes, where my gut goes, where my head goes, and build a portfolio around that. And that's super satisfying and super enjoyable. And I think that's important because it's a lot of what we built PlayMoney around. So how things work on the platform for founders and funders. Think of PlayMoney like Instagram for angel, right? Every week we serve you as an individual up 1 or 2 deals that we think you are really going to like. It could be based on what you liked before, what you told us you're interested in, what we've seen from your behavior. Like for me, I like high energy founders. So PlayMoney would show me high energy founders all the time. There's certain other angel investors. I really like their style and I like the kind of things they think about and what they invest in. PlayMoney would show me more of the stuff they were investing in. So we really want to make it like Instagram for angel, 1 or 2 deals a week curated just for you. And then we share everything about that company that you would want to know to make a decision. And this isn't just like long text memo. It's you see the founder pitching on video. You watch us do a deep dive Q&A with them where they tell you stuff about their business. You see parts of the deal memo from their lead investor. You see other investors' opinions, other angels' opinions and why they invested in the company. So we're looking to make it a really robust and rich experience that, if you tune in every week, you may see a deal that you love and you can invest in. And maybe you don't love the deal, but we hope that you take away and learn something about the market or the industry or the founder or yourself and what you like or don't like. So we're looking to make it sort of fun and entertaining that way so you can really build that portfolio, but still spend, an hour or less a week on it.
And for the founder side, like I understand why that is so much easier and way more amazing for them. But can you share a little bit about why that is so helpful to a founder that is trying to pitch angels?
Oh my gosh, the founders are going bananas about it. And it's so weird because we started out with the angel first because the angels are the ones putting the money on the platform. Founders are going bananas because they go on the platform and all of a sudden they have this like interactive deal memo that when someone's interested in angel investing to them, they can send them the link to their PlayMoney profile and get a big chunk of a first meeting out of the way. Founders are seeing angels invest just off of that. They don't even need to get on the phone again, right? Oh, good. There's a big green button. I can just go invest and it takes 2 minutes. So founders are loving it because it's saving them a ton of time with first meetings. They're loving it because it allows them to say yes to checks of any size without the overhead of picking up individual investors on their cap table. They love it because of that. And then they're loving it because when their deal has traction, whether it's because they had a lead investor or they bring in enough investors of their own, we've been able to share it with the broader PlayMoney community. And we just had a founder double what she raised on her own when we put her deal out to the community. And it was super exciting because those were a whole bunch of angels she didn't know before. And it wasn't just capital. Like this was a company in the sports data space. And she ended up with the former president of a publicly traded running company in her SPV. That angel is going to be super useful to her. And along with the cash with the SPV, we also gave her a list of all the investors in that SPV. So she can treat them like regular investors on her cap table. She can leverage their expertise. So the founder's thrilled. The angel is thrilled because now she can be of value to this company and sort of go along for that ride on the angel journey and not just sort of, locked in a black box of an SPV. So it's been super awesome to see. Like founders have been like, I think I even undervalued how excited founders were going to be.
Yeah. I mean, just a huge saving of their time. It's insane that founders go out and pitch like 100 angels for literally one raise. I mean, it's just crazy.
I think it's important to understand, like, I think some founders understand this, but not all of them do, is that you don't want a gazillion individuals on your cap table. It's really expensive legally and administratively as your company grows. But to do something like this even on AngelList, where you don't get the interactive deal memo, right? But at least you can pull all your angels into a roll-up vehicle or an SPV. You've got to raise $100,000 from angels to be able to do that on AngelList. That's a huge hurdle. So unless you have $100,000 of small check angels living in your own network, you actually can't do this affordably on AngelList. And that's a big deal.
Can you just explain and level set for everyone? Like, what does it mean to invest in an SPV versus investing directly on a cap table? And like, what kind of check sizes would be expected for each option?
So an SPV, it's short for special purpose vehicle. Pretty much it's like a mini investment fund that's only investing in one company. Because we pool people's money together in the SPV shows up as one line in the cap table for the founder. And you can have, 249 investors in that SPV. So it's much easier administratively for that founder going forward and building their business. As a result, SPVs will take much lower check sizes than most founders will take directly on their cap table. So we had a founder today. We have an SPV on our site that's super, super exciting. I love it. I'm investing in it. I love the company underneath it. But his minimum check size on his cap table is $25,000, and rightfully so. I can't write $25,000 checks, right? My budget for the year is $35,000 for all of my angel checks. So the SPV allows me to write a smaller size check, but still invest in the company. So I'm writing a $2,500 check to that company. We have someone in the SPV that wrote a $10,000 check. We have someone else that wrote a $500 check. but we'll pool all that money together and then invest it.
Great for people to hear that, like, you can literally start with $500.
Oh, you absolutely can. And you should be able to. We've got a few of those folks, and they're building diverse portfolios. It's so exciting.
What are like some of the biggest mistakes either you've made as a first-time angel investor or that you've seen other angel investors make along the way?
First mistakes. That's a great question. I've made a few of them. The biggest mistake I've seen other angel investors make is they invest too much in their first deal. They haven't thought about diversification. They haven't thought about their budget. So they see a company they really like and they dump what should be their year's budget for angel investing all into one company. And you'll know you have one of these angels like this because you'll run into them and they'll be like, oh, I ran out of money. I'm not angel investing anymore. I'm like, that is a product of you not setting your budget correctly. So I see that happening, and hopefully it's happening less now that SPVs and smaller checks are becoming more the norm, or at least something we talk about. That's the number one mistake I see in angel: too much money into too few companies. The two places I have regrets as an angel, it was both were early on. The first one was a company I was super excited about. And the founder had an SPV. She was running her own roll-up vehicle. And she had it listed that her minimum check size was $5,000. And I was just not brave enough or bold enough to ask if I could write a slightly smaller check. So I didn't. I wrote a $5,000 check into that one. Still super happy with the investment, but from a portfolio diversification strategy, wasn't my smartest move. And I learned, at the time, I could have probably asked for a lower amount that fit my investing plan, particularly because I wasn't actually going to be on her direct cap table. The second mistake I made, man, and I think about this one all the time now. There is a company I loved. It was called Pressed Roots. I love the guy leading the syndicate. His name is Andy Lewis Charles. He gave us some of the initial input to PlayMoney. She has gone on to raise her Series A with like Naomi Osaka, the founder. She was extraordinary. And I got cold feet on pulling the trigger on the SPV because I thought the fees were high. Like, what kind of damn fool am I, right? Like, I was like, oh, those fees look a little high. I'm not so sure about that. Like, first of all, the way venture works, like, it's from big wins. So like that 10% SPV fee actually was a rounding error and it didn't make any bit of difference. Second of all, that 10% SPV fee, it's still less than the fees that you pay when you invest in a fund. So I was like, I get to custom choose the company I'm investing in, and I'm still paying less than if I gave my money to someone else to invest for me. Like, what was I thinking? And like literally, Ruffin, I think about this company on a monthly basis. And I actually went out and like found a company in a similar space. They're not competitive at all, but it's in a similar space to put on PlayMoney because I wanted to invest. I wanted to be in that market segment. And one had one had a Harvard HBS founder. The other has a Wharton HBS founder. So like, depending how your trade-offs go, but I think about it all the time.
What are the typical fees, like the average fees on an SPV that someone should be like looking for?
I don't think there is any platform out there that will charge more than 10%. They'll just, like, AngelList will cancel your SPV if they have to charge the angels more than 10%. Like, so for understanding, if people don't understand how SPVs work, they're mini LLCs, which means they need to be registered with Delaware. There's a filing fee. There's some state filing and regulatory fees that have to get paid. The platform or the person running the SPV has to monitor that and issue you tax reports. So there's actually very real costs with running an SPV, just like there's real costs running a venture fund. And most people don't know this, but there's real cost to a founder to taking investors directly on their cap table. So there's this pool of cost that someone's going to pay somewhere. So the typical thing you'll see is there'll be a certain amount of charges, but they'll be capped at 10%. And that's actually how we operate in PlayMoney, right? So there's a 10% one-time upfront fee that's taken off the top. We cap that dollar amount at $1,500. So if you're investing, $20,000 in a company, you'll pay a little less than 10%, but we take that amount off the top and then the rest goes to the founder. And that pays us to source the deals, vet the deals, put them on the platform, do all your taxes, manage that investment for, a decade until it exits.
Good to know, and also good to understand like why those fees exist. Kind of want to shift the conversation to your fundraising history and also like any advice you would have for founders. So you're backed by M13 and you've previously raised $20 million in venture capital from your previous two businesses. So what kind of are your biggest learnings and strategies you would give other founders that might be going out for their first fundraise, whether that's for approaching VCs or angels?
Right. All right. So what advice would I give to founders? What I see most frequently, right? Because I work with, scores and scores of founders going out to do their first raises. And what I'm seeing is that most really don't understand how VC as an asset class works. Like, understand the kind of returns that are expected, understand why. And I think you need to adequately understand that to understand how to pitch your company. Because you need to be pitching something that is big enough for those kind of investors, big enough given their fund size or the kind of returns they need to see. Because even a small fund, if you're raising from a $10 million fund, like they can't even own 10% of your company, but let's say they could. They could own 10% of your company with a $10 million fund. They can't, but if they could, you would still need to exit your business at $100 million for them to deem that a successful investment. So think about that as funds get bigger. Think about that as their ownership stake gets smaller. You're playing a real big ticket game. And so I think if founders go in understanding that, it shouldn't deter them. It should help them gauge how they tell their story to capture an imagination about building a really big business in a really big space. And that would be my number one piece of advice. And I think some days, I should take my own advice again. I forget that advice. I caught myself pitching for PlayMoney and maybe pitching a little too small. And I think that's just something founders need to work through. Maybe my biggest piece of advice. I think my second piece of advice is just be careful who you take as your investors. There's a lot of things you can't control. And we always make it sound like in fundraising, every founder has a whole ton of choices. Oh, I'm choosing between 5 term sheets. It's a bunch of bullshit. 90% of us have one term sheet to choose from. And what are we going to do? Say no? Doesn't happen that often. So, but know that that's going to have an impact on your company. And it's something you're signing up for by taking the money, which is why I'm so excited about angel money, because it operates like there's a term Bryce Roberts uses about entrepreneurship. He calls it permissionless entrepreneurship. And that's the kind of entrepreneurship he's trying to fund with his new fund, Indie VC. They're still looking for the huge exits, but there's a different flexibility he wants his founders to have in how they build their businesses. And I think angel capital becomes this brilliant permissionless form of capital, right? It's not dumb money by any stretch of the imagination. It's super smart money. And it's even smarter money for the founder because it gives them optionality at the pace at which they build their business, how they build their business. And that's what I think founders need to understand that. And that is what I think about when raising money right now. Who do I want to take that money from and what does it mean about my business? Right? If my business isn't going to be a $10 billion business, do I want to run a $500 million business and still be really successful and throw off cash all day long? Hell yeah. I don't want to have to shut that down. I want those choices.
Anything that founders can look for when they're meeting with VCs that might be green signals, bad signals? Any thoughts there?
I don't know. If you're getting bad spidey senses about a VC, trust your gut on it, right? I mean, that's such a hard thing to say because really, who turns down a term sheet, right? And frankly, you don't usually get to a term sheet unless both sides are vibing on each other, right? Because it's a very personal relationship, especially in early stage funding. So much as a judgment of the team and a relationship. So I don't know if there's any like red flags or green flags. If someone's creeping you out and feels like a creeper, though, run away. Guess what? They're probably a creeper. Just trust yourself and trust your judgment.
I think that's a good motto to live by in all parts of life.
In all parts of our life, I know.
And then I feel like we could talk for a whole nother hour, but I want to keep you on time. So closing question, can you share a female founder, investor, or leader who inspires you and a little bit about why?
This is such a good question. And we had such a fun little group Slack about it earlier today at PlayMoney. So I'm going with, right? Like it was a super fun conversation. But like, I'm going to go a little big and old school with that one. And I'm going to say Cindy Gallop. I think, and you know Cindy Gallop, right? She's sort of all over the place. She's been around for a minute. She's been such a vocal and relentless in her support of female founders. But she's got a way of doing it without like being that like, that whiny about the 2%. Like we're waiting for someone to come save us. We only get 2% of the money. Like someone comes, she's like, we're saving ourselves, bitches. And I adore her though, because she's always amplifying all of our voices. And she's got just like the joyful out of fucks to give that comes with getting older. And she's unabashedly just leans into it. And like, that's who I look up to. I want to be as fabulous as Cindy, you know, when I'm 15 years older than I am, or 10 years. I don't know how much older than me she is, but it's fabulous. She's fabulous. And that's who my person is.
Amazing. What a great way to close. And then final question, where can people find you and where can they find PlayMoney?
Oh my gosh, everyone should just come on PlayMoney right now. If you're an accredited investor, man, it's the best place to lurk and learn, even if you're not writing checks yet. So you can go to letsplaymoney.com to find us on the web. You can find me on LinkedIn under my name, Cheryl Kellond, or on Twitter at XXFounder. All my spiciest takes are on Twitter.
Love that. And I did a lot of lurking before I wrote my first check. So definitely go lurk on PlayMoney and learn a lot in the process. I did. Yeah.